Good evening, everyone. Very good evening, everyone. Many of you have joined. Vedika, Nyanesh, Jyoti, Alok, Mitesh. How are you all? I hope you all are doing good. I welcome you back again to this exciting session of financial management, wherein in today's session we'll be doing the revision aspect of the two chapters that we have completed. Since you have completed ratio analysis and also the capital structure portion, we'll be going through the revision part of it. We'll be doing some small points that are left out here and there, and also doing some extra questions based on the same thing. Okay. So let's get started in ratio analysis. We have yet to complete few ratios. Few concepts are pending. So let's do that initially. So we'll complete those concepts in the first half before the break, and also the questions based on ratio analysis. And then in the second half, which is after the break, we will go for revision of capital structure stuff. Okay, fine, guys. So let's proceed with some ratios that are pending. 3 concepts are pending in ratio analysis. We'll complete that and then go to revising the earlier ratio. Okay, so let's begin. The first ratio that we have yet to cover, that's called as the market value to book value ratio, right? Market value to book value ratio. Well, the formula for this market value to book value ratio is market price of share upon book value per share. So market price per share upon book value per share. That's the market value to book value. Now, what does this ratio indicate, and what are its implications? All those things we are going to discuss. But before that, let's try to understand this ratio properly. On the numerator side, we have the market price of the share. It's the share price which we observe in the market, or the price at which it is being traded in the market, right? At BSE or NSE, whatever is the price of that share, the trading price of that share, that's your market price per share. Fine. Then we have book value per share in the denominator. Now, what is book value per share? Let's try to understand that in a better sense. Let's understand what's the book value per share. So if you look at the balance sheet of a typical company, let's say balance sheet of a company, on the asset side, we have some fixed assets, we'll have some current assets. So let's say fixed asset is amounting to 1 crore, and company has got a current asset of 50 lakh, and company will be also having some debt and some current liability, right? So let's say that is debt and current liability translates to 40 lakh. Of course, whatever is left out over here, or we can say equity share capital, the amount of equity share capital which the company has got, that is, let's say 50 lakhs, and the reserves, the retained earnings, that amounts to 60 lakh, and that tallies our balance sheet. Now, if I ask you what is the value of each share of company, if I ask you what is the value of each share of company, so let's say I give you the information as number of equity shares that the company has got. Number of equity shares that the company has got is, of course, based on the face value figure, that's a face value of 10 rupee. So we can say number of equity shares is 5 lakh. Number of equity shares is 5 lakh. So when we say book value per share, when we are talking of book value per share, it simply means the net worth of the company divided by the number of shares. Okay, so book value per share is basically net worth or equity shareholders fund divided by the number of shares. Net worth or equity shareholders fund divided by number of equity shares. So net worth or equity shareholders fund divided by number of equity shares. So what is the net worth? Net worth over here, it's going to be obviously the share capital and the reserves. So that totals up to like 50 lakh plus reserves of 60 lakhs divided by number of shares is 5 lakh. So as per the books of accounts, what we observe is the share capital and the reserves in total make up 1 crore 10 lakh or 5 lakh shares. So each share, net worth of each share, it works out to be 27.5. Net worth for each share. No, is it 27.5? No. How much is this, by the way? 1 crore 10 lakh divided by 5 lakh. Okay, that's 22. That is 22. Okay, 22 is the book value per share. 22 is the book value per share, or I can say this 22 figure denotes what is the value, what is the book value of the assets net off with liabilities in the balance sheet of the company. Or I can say this is the accounting value of each share, which takes into account the book value of the assets as adjusted by the book value of the debt or the book value of the debt and current liabilities. Okay, this is the book value per share. Now, if I tell you, sir, in the balance sheet of the company, the assets that it has got, and after adjusting it with the liabilities, value of each share should be 22. In market, we find that market price of the share is, let's say, rupees 44. Let's say it is 44. So if you just go ahead and calculate this, this works out to be 44 divided by 22, which is 2. And it is obviously 2 times. Or I can say market price is actually 2 times of the book value. Market price is actually 2 times of the book value. Okay. So market price, when we say it is 2 times, what do you feel? What does this number indicates? Is the share valued higher than its book value? Yes, it is. It is valued higher than its book value. Now, why people are ready to pay double the price of its book value? Can you tell me? Why people are ready to pay double the value of the book value? Because as per books of accounts, the value of asset adjusted for depreciation as reduced by the liability value, we say that per share the value is 22. Correct? The per share the value is 22 and market price per share is double of that. Now, when you say market price is double of that, it means the share is in great demand because people are ready to pay double that of market price. Right? So in our books, even though it is 22 as per the assets and liabilities, but in the market, people are ready to pay double price for it. So what does that indicate? It indicates that investors have good amount of confidence. It simply indicates, guys, that there is a good amount of confidence with the investors, or investors have a greater confidence on the company, right? So it actually indicates, we can say the point over here is higher market value to book value indicates investor confidence. I can say investors have a greater confidence on this company, and therefore they're ready to pay double the price of the book value. Therefore, they're ready to pay double the price of the book value. And you can observe from any company point of view, all the good companies have this market value to book value ratio as a higher figure, right? So let me just show you some numbers, the real life example. I'll just take you to BSC website to show you what are this market to book value ratio. Let me just take up this. Yeah, market value to, or it's also called as a price to book value ratio, by the way. So let me just show you the pricing to you. Okay. Yeah, 1 second. Okay. You can see this. I'm going to the BSC website. On that, I'm just showing you the price to book value ratio of any typical company. You can just lay, let's say, I'm talking of Reliance Industries. Okay, you can see this number over here, PB, price to book value or market value to book value ratio that we were talking of. You can see that it is having a value of 3.32. What does this 3.32 indicates? This 3.32 actually indicates that, sir, this typical company is having, market value which is triple that of its book value. It means in their books of accounts, whatever is the value of uh, in their books of accounts, whatever is the value of the share, market price is actually triple of that. Now, if you look at any other company, now this was the manufacturing industry, right? If you look at typical banks, let's say I'm looking for Kotak Bank, you'll find a price to book value as that's 4.56, right? 4.56. So it means it's 4.5 times of the book value. Or if you look at TCS, some of these companies, the IT companies, they have a price to book value to a larger extent. So let me just say Tata Consultancy. Yeah. Just show it to you. TCS. Yeah. Look at this massive price to book value ratio. 15.34. Price to book value ratio. That's really massive. 15.34. Right. Now, why Tata Consultancy Services is having such a high price to book value? Is it overvalued? Is it some sort of scam, sir? No, it's not at all. Because when you have this sort of price to book value higher numbers, You need to actually get into the fundamentals of the company, that whether company is really generating profits. And if the company is generating profits year on year and it is growing year on year, its revenues are rising, its profit margins are doing good, it means there's a future growth potential. There is a great growth potential in the shares, and therefore people are ready to pay a 15 times of its book value, right? So future cash flows are expected to be higher. So that's what we mean by the price to book value ratio over here. Okay. So that's what we're talking about, the ratio of market value to book value, or it's also called as a price to book value ratio. I hope you have understood what is this price to book value ratio. This is typical the market price of the share divided by the book value of the share. Are we good with this ratio, everyone? Yeah. Now, the next ratio, which is Q ratio, is also on the similar lines. Q ratio is also on the similar lines. It talks of a bit different. It says the Q ratio is actually market price of all shares divided by replacement cost of assets. So Q ratio is market price of all shares upon replacement cost of assets. Okay, so that's your Q ratio. We are talking of Q ratio. It's again somewhat a replica of market value to book value. But here, instead of taking the book value of the assets, what we take is replacement cost. Now, what is this replacement cost? It means today, if I want to replace my assets with similar assets, what will be the cost that I'll have to incur to get these assets into my business, right? So generally, if you find this, let's say market value of all shares is suppose 1 crore. Market value of all shares is, let's say, 1 crore, and replacement cost of the asset is maybe 60 lakh. Whatever assets the company has got will need 60 lakh to replace them, whereas the market value of all the shares is 1 lakh. Then of course this is going to be a number which is 1.67 times. It means market value is 1.67 times of the cost of the asset that the company has. Again, here also it indicates the investor's confidence. This also talks of investor's confidence, and higher this number, the greater is the investor confidence. There is no ideal ratio as such. Okay, for these two, there is no ideal ratio, because we saw that in our example also, some of the prominent companies that we saw, Reliance Industries, we saw Tata Consultancy Services, we saw Kotak Mahindra Bank. So all those companies were having different price to book value. TCS, you found that it is having a price to book value of 3 times, right? So sorry, it was 15 times. So there is no ideal ratio as such. It depends on the industry. Generally, the service-oriented industry have these two ratios to a larger numbers. Okay, whereas when you look at the manufacturing industries, they have this number to be a lower number. Now, why is it so? Because in case of service industry, they have those intangible assets, which may not be having any book value in their books of accounts. They may not be having any value as such. But when you look at it in the market perspective, that has got a great amount of value, right? For example, if TCS is creating some software, the cost to create that software is what? It's just the cost that you pay to your employees, the employee salary, right? And some sort of equipment that you have. Whereas the software that is generated, software that is created will have a good amount of market value. And that's where the market value is going to be very high as compared to the book value. Okay, guys. So these two ratios were again an indicator of investors' confidence. Higher the ratio, the better it is. Okay. Now it's time for us to look at a really interesting topic called as the Dupont analysis. The Dupont analysis. Okay. Now let's discuss about this Dupont analysis, guys. Come on. Dupont analysis is actually going in detail of what's happening in the company, what's happening in the company's balance sheet and P&L, and analyzing it in a very detailed manner. Okay, so let's look at this Dupont analysis. It's a chart, basically, Dupont chart, which helps us to go in detail about what the company is doing. The first thing that we look at is return on equity. How do we compute the return on equity, guys? How do we compute the return on equity? Return on equity, the return that is given to the equity shareholders. How do we really compute it? What's the formula for return on equity, guys? Tell me. Yeah. Any any thoughts? What's the return on equity? Well, we know that it is profit after tax upon equity shareholders funds. Correct? Return on equity is what we say as profit after tax upon equity shareholders funds. Now, this figure, return on equity, that is calculated as PAT upon equity shareholders fund, it doesn't come on its own. It has actually got certain sources. It has actually got certain sources. There are two sources to it. Now, if I tell you that there are two companies, company A and company B, both of them have a return on equity of 20%. Both of them have the return on equity as 20%. But we need to go in detail. Now, when I say in detail, I want to know which of these two companies, A and B, I want to know out of these two companies, which one is having what characteristic, or I want to know something in detail. What is driving, what is causing this return of equity at 20%? So what DuPont analysis does is it actually tries to establish return on equity as a function of two more ratios. It is trying to establish its, the return on equity as a function or as a dependent thing from two ratios. Now, if I simply ask you, you want to provide greater amount of return to your shareholders. You want to provide greater amount of return to your equity shareholders, or you want to earn in percentage terms a greater percentage for your equity shareholders. How is it possible? How is it possible? First, one thing would be, so do one thing, increase the sales margin. The profit that you make on every rupee of sale, the profit that you make on every rupee of sale, try to increase it, right? So this can be achieved by what? Increasing the selling price, the reduction in the cost, either of these two, right? So when we're talking of sales margin, essentially, I mean, you are looking at increasing the sales price or reducing the cost price of the product. So if you want to increase your return on equity, you need to work on sales margin. Higher the sales margin, greater will be the return on equity, right? That is one idea. Or, sir, if it is not possible for me to increase the sale price, or if it is not possible for me to reduce the cost price, so my sales margin will remain constant at 10% or 15% or 20%. So how do I generate more returns for my equity shareholders? Tell me. If it is not possible for me to increase my profit margin, let's say I'm working with a profit margin of 20%, 20% of sales. Okay, 20% of sales. Now, if I'm working with this profit margin of 20% of sales and I want to increase my return to equity shareholders, how is it possible if I cannot increase the margin? The only way to achieve that higher return on equity is to work on quantity of sales. Working on the quantity of sales. So basically, we can say profit after tax. Profit margin is denoted as what? Profit after tax upon sales. And quantity of sales, that's actually denoted as sales upon equity shareholders fund. Or I can say, sir, what the ratio we had as PAT upon equity shareholders fund, That is actually PAT upon sales multiplied by sales upon equity shareholders fund. So when we are talking of return on equity over here, return on equity is actually a function of two parts. One is the sales margin, the margins that you have on each rupee of sale, and the second is the turnover ratio. See, this is the turnover, sales per unit of equity shareholders fund. Sales per unit of equity shareholders funds. For example, for company A, we say that the return on equity, it is 20%, and we found that this 20% is actually derived as 20 lakh of profit upon 1 crore of equity shareholders fund, right? And B is also having same 20% as return on equity, which is 10 lakh profit on 50 lakh equity shareholders fund. So this is like PAT upon equity shareholders fund. So at the end, we say that both of them are earning 20% for their equity shareholders. So what's the distinguishing factor between both of them? So I just go a bit down and I find that for company A, the profit margin for company A, profit margin, which is PAT upon sales, we find that it is 20 lakh on a sale of 20 crore. Okay, and over here we say that it is 20 crore is the sales figure, which is sales upon equity shareholders fund, and equity shareholders fund is 1 crore, right? So this is basically you can say the PAT margin is 1% and turnover is 20 times. So margin is 1%, whereas turnover is 20 times. Margin is 1%, turnover is 20 times. It means the company is actually operating at a very thin margin of 1%. Company is actually working for a very thin margin of 1%, and 1% margin is being earned by company 20 times in a year, and that actually translates return on equity as 20%. Okay, that actually translates the return on equity as a 20% figure. So we find that company A is generating 20%, but it is majorly due to higher sales of the company, due to greater times of the sales. I can say equity shareholders fund is just 1 crore. With just 1 crore investment, the company is able to generate 20 crores of sale. And that's what we mean by this turnover of 20 times. Okay, so over here, the strong point for company A is its turnover. Now, if you look at company B, if you look at the company B's figure, what we find is, let's say, distributing it again into two parts. PAT upon sales, PAT upon sales, that's going to be 10 lakh PAT on a sales of 2 crores. And when we look at the other aspect, which is sales upon equity shareholders fund, we find that sales is 2 crores on an equity share capital of 50 lakh. So here the margin is 5%, whereas the turnover, the margin is 5%, whereas the turnover is 4 times. Okay, so we find that these are the two aspects that we have. Okay, so what we find is 1% margin was with company A, whereas company B makes a margin of 5%. So which is a strong area of each of these companies? Which is a strong area of each of these companies? So you find that as far as margin is concerned, this is a strong area. Company B is having a strong area. Whereas the times you are selling, it's company A which is having a greater role to play. So even though both the companies are having a return on equity as 20%, even though both the companies are having a return on equity as 20%, still what we say is company A is actually having a strong area as turnover and B is having a strong area as margin, right? So if company A really wants to ramp up its return on equity, if company A really wants to ramp up its equity, wants to increase its return on equity, then the only way to do it is increase this margin. Just imagine if this margin increased to 2%. Can I say it will become 2 into 20? That actually becomes a 40% return on equity. Whereas if this company actually should work on increasing the sales, maybe sacrifice some of the margin, but try to increase the sales because that will lead to increase in return on equity. So as a consultant, if you were to advise to company A and B as to what they should be doing to increase their return on equity, one thing is they can simply work either on the turnover part or they can work on the margin part. Okay, so they can work on the turnover part or on the margin part to increase their profits or to increase their return on equity. Okay, fine. By the way, these sales figures are what I have assumed to be my numbers. So to make it as a 1%, that's 20 lakh upon 20 crore, and for this it was 20 crore upon 1 crore. So that should actually make up this 20%. So these were all not a calculated numbers, but given numbers. Okay, so that's the Dupont part at 2 level. By the way, we have considered Dupont at 3. We are going to learn it at 3 levels. At 2 levels, your Dupont is like if you want to increase the return on equity, you should be working on. If you want to increase this return on equity, you should be working on what sales margin or the quantity of sales, basically the margin and the turnover, right? So if we talk of A, if A increases its margin, it can go for higher return on equity, and B should actually work on increasing the turnover. Okay, fine. That's the 2 layers of analysis of Dupont. But we also have a third layer of analysis, wherein we talk of this return on equity from 3 point of view, from 3 ratio point of view. So our return on equity is actually going to be a function of 3 ratios. One is, of course, the profitability. Other is the turnover, which we have talked of as of now, which we have discussed right now. These two are the parameters which decide what will be your return on equity. And the third one is what we call it as equity multiplier. Equity multiplier, or we also call it as leverage. Also call it as leverage. So profitability is PAT upon sales. Profitability is denoted as what? PAT upon sales. Over here, turnover we are going to say as sales upon assets, and equity multiplier is the total or value of assets as divided by the equity shareholders fund. We know return on equity was what? PAT upon equity shareholders fund. We just distributed this ratio into 3 sub ratios. One was PAT upon sales, second is turnover, which is sales upon asset, and third is the equity multiplier. So if we talk of what question does these ratios answer, the first one is what percentage of sales is the profit or the margin? What percentage of sales is the profit or the margin? Then sales to assets, this is going to be how many times of assets is sales. That is, for a given level of asset, what is the amount of sales that is generated? And then this is the ratio of assets to owned funds. This is the ratio of assets to owned funds. So let's say if a company has a profitability of 20,000 on a sales of 10 lakh. So what's the profit margin that it has? It has a profit margin of 2%, right? How many times of assets is the sales? How many times of assets is the sales? So we say the sales is 10 lakh and the company has an asset of 5 lakh. Sales is of 10 lakh and the company has an asset of 5 lakh. So that actually makes this as 2 times, or I can say your sales is double that of assets. Then further multiplied it by assets to equity shareholders. So sir, of the assets 5 lakh, the company has a equity shareholders fund of 1 lakh. So that's 5 times. So basically you can say this works out to be a profit, or you can say 20% as the margin. 20% is the margin. So if I ask you, so this is the 20% is the return on equity, 20% being the return on equity number that's pat upon equity shareholders fund. How do you derive this 20%? How do you derive this 20%? That is what we want to know. So we want to know how do we derive this number? What are the various sources from which this 20% is generated? So we say 2% is generated as a profit margin. That gets multiplied by 2 because I am making sales twice that of my assets. Whatever is the count of assets, what is the amount of assets I have, double of that is my sales. So basically on my assets, I'm having 4% return. On my total assets, I'm having a 4% return. Sir, all my assets are not owned by me because we find that asset to own fund ratio is 5. It means the assets that I have is actually 5 times of my own funds. So this 4% is actually being earned multiplied by is actually being earned by the assets. But what I have is a ratio as asset to own funds being 5. So this 4% is earned on my assets. So if I talk of on my equity shareholders, how much did I earn? It's actually 5 times, right? So 20% is being derived by these 3 numbers. So if I ask you, sir, if I want to increase this number of 20%, if I want to increase this return on equity number of 20%, how can I do that? First and foremost, try to increase the profit margin. If my profit margin increases from 2% to 3%, you will see there will be a massive jump in. Similarly, try to sell as many times as possible the sales. So if you're going to sell more number of times, that's going to provide you a greater return. Then if you're looking at this number 5, it's the leverage. It's the ratio of assets to equity shareholders fund. So what you can do over here is you can reduce your equity shareholders fund by substituting it with debt. If you can make this 5 as 6 by taking more debt, then that is quite obvious. This return is going to increase. Okay, fine. So return on equity is computed as pat upon equity shareholders, no doubt in it. But then we are looking at the reasons for that typical number. We know that we'll get 20% because over here the PAT is 20,000, equity shareholders fund is 1 lakh. You can get it 20%. If you want to get in-depth detail as to why is it 20%, from where is it being derived. So there are 3 sources for this 20%. One is the 2% profit margin. Second is 2 times turnover. And third is the 5 times leverage. Okay. So that is about this Dupont chart, guys. Okay, Dupont analysis, the 2-level and the 3-level Dupont analysis. Definitely profitability and turnover was looked at, and also in the third part we bring in the equity multiplier concept. Okay, now I'll just revise the ratios quickly. And meanwhile, I want you to post the questions from module that you want me to do or want me to revise as such. I'll do that. So I'll take around 10 minutes to look at all the ratios. And meanwhile, you can post the question numbers from the module which you want me to revise for you. I'll definitely do that after revising the ratios. Okay. Now, the ratios that we started with, this was about first the liquidity ratio. So then we had the leverage ratio, activity ratio, profitability ratio, right? So first we started with the ratio of current assets, current ratio. So current ratio was basically current assets upon current liabilities. Okay. And we said that the ideal ratio over here should be 2 because if the ratio is below 2, then it indicates that the company is not in a liquid situation. Company is not having enough liquidity. Now we said that a higher current ratio indicates better liquidity. However, very high current ratio is actually indicating some sort of inefficiency. Now, inefficiency in the form of selling, in the form of collection, in the form of investment. Okay, so ideally the current ratio should be 2:1. Then we found that in spite of having the ideal ratio as 2:1, we find that sometimes it is quite possible we may not be able to honor our creditors. And for that reason, we computed another ratio called as a quick ratio or acid test ratio. The acid test ratio was quick assets upon current liabilities. Quick assets are basically current asset minus inventory minus the prepaid expenses divided by current liability. So basically, we can say quick assets included your cash and bank balance. It included the debtors. Okay, so those were included, and also it included marketable securities or current investments. Now, cash ratio or absolute liquid ratio is another level of this quick ratio, which is even more strict, which simply talks of the numerator being cash, bank, and marketable securities as divided by the current liabilities. Okay, as divided by the current liabilities. So these were all strictly speaking the cash ratio that we had. Okay, then how do we check really there are sufficient quick assets? So for that, we looked at basic defense interval ratio and daily operating expenses. Basic defense interval ratio, it was about how much cash and marketable securities we have as compared to operating expenses per day. And whatever our answer was, that was in days. Daily operating expenses, we computed it as whatever was our COGS, general admin expense, plus selling expenses as reduced by any amount of depreciation and divided by the number of days, which was basically whatever was your annual expense, annual cash expense divided by the number of days. And this was taken as a denominator. Now, next thing that we did was calculation of some of the long-term liquidity ratio. Now, long-term liquidity ratios included proprietary ratio, debt equity ratio. So, proprietary ratio or equity ratio is simply shareholders' funds upon net assets, which means whatever was the amount of net assets, out of that, how much is shareholders' fund. Similarly, we had debt ratio, which was total debt upon the net assets, which is simply the first ratio talked of what proportion of your assets is equity. This talks of what proportion of your assets is debt. Similarly, we have debt equity ratio, which was borrowed funds upon own funds. Capital gearing ratio, it had preference share capital plus debt upon equity shareholders fund. Always remember, equity shareholders fund will be derived by reducing the fictitious assets. The numerator, preference share capital plus debt. Numerator, preference share capital plus debt. That was the capital gearing ratio. These two were the funds which required a fixed rate of return. Okay. So of course, if equity ratio is higher, it indicates higher solvency and lower risk. Same way, if the debt ratio is higher, it indicates lower solvency and higher risk. And for debt equity, higher debt equity means lower solvency and higher risk. Now, what was capital gearing that we have discussed already? We simply said that it's a simple relation between return on capital employed and return on own funds. If your return on capital employed is greater than the rate at which you are borrowing money, your return on own funds will be a bigger figure, right? So return on net worth or return on equity will be amplified. It will be a multiple if you go for capital gearing. Now capital gearing was feasible only if you had sufficient amount of EBIT being generated by the business. So if your business is generating 10% and if you have borrowed at 8%, then it makes sense because that actually adds to your margins and actually leads to an increase in the return on. Then we also say what is the capability of the company to honor the payments. First is interest coverage ratio. If the company has a greater capability to pay interest. Second is preference dividend coverage ratio, which was pat upon preference dividend, which said about what is the capability of the company to pay preference dividend. Similarly, fixed charge and debt coverage ratio were taking into consideration the interest as well as the principal repayment. In fixed charge, it was only EBIT being added with depreciation, which was a figure of also called as EBITDA. Debt service coverage ratio, it was a more detailed number, which was PAT plus interest plus any non-cash expense. And also we are going to exclude the non-operating items. Because in EBIT, we may have some operating figures, but this non-operating items will be adjusted if you want to look at the debt service coverage ratio. Okay. Now, along with this, what we saw was some of the turnover ratios, and we found that turnover ratios all of them were having the format as sales or COGS upon that typical number. Okay. So total asset turnover was sales upon average total assets. Fixed asset turnover was sales upon average fixed asset. Capital turnover was sales upon average net assets. Current asset turnover was denominator being average current asset. Working capital denominator being average working capital. Then we saw inventory or stock turnover ratio, which was also said to be the stock velocity. Now, this inventory or stock velocity is computed as cost of goods sold upon average stock, which simply tells us how many times one lot of stock was sold. Like in case of company A, it was 3 lakh the average stock on a COGS of 12 lakh. So 3 lakh average stock on a COGS of 12 lakh. So that simply said that we were selling 4 times of our average stock, and for B, it was 5 times of the average stock. Okay. Same way it was receivables turnover. Even you can get the inventory holding period in number of months or in weeks or in days also. For the profitability ratios, we had the GP ratio, net profit ratio, operating profit ratio, and all these COGS ratio, operating ratio, finance expense ratio, right? How do we measure the return on investment? That was return upon investment, and for that we had return on assets as EBIT upon net assets. You may also have it as PAT upon net assets. The question will clearly specify whether you have to take EBIT or net assets. Return on capital employed, it was EBIT upon total capital employed. After tax, it's going to be EBIT 1 minus T upon total capital employed. And return on own funds or equity is what we have computed already. Some of the market ratios that we had: earnings per share, dividend payout, retention ratio, P ratio, which was again an indication of investors' confidence, dividend yield, earnings yield. Dividend yield being the amount of dividend divided by the market price per share, and earnings yield being earnings per share divided by the market price per share. And then we saw today the market value to book value ratio, Q ratio, and the last but not the least, the Dupont analysis. Okay, so let me look at the queries if there are any, and then we can take up some question. PDF is not available. It will be available, Nanesh. I'll be putting this PDF after today's class because we'll be completing the ratio part today. Okay, fictitious assets. Fictitious asset means the amount of miscellaneous expenses not written off, preliminary expense not written off, which remain on the asset side of balance sheet, but they are in essence, no asset. That's it. Okay. So next is practical question 8. Ganesh is asking for practical question 8 and Sapna is asking for practical question 9. Okay, fine. Let me just bring those things over here. Just open the file. Ratio analysis. Okay. So which question we were asking for? Question number 8. Okay. Practical question number 8. Fine. Gig Limited has furnished the following information relating to the year ended 31st of March 2020 and 31st of March 2021. Share capital is 40 lakh. Reserves and surplus is 20 lakh, 25 lakh. Long-term loan is 30 lakh. Net profit ratio is 8%. Gross profit ratio is 20%. Long-term loan has been used to finance 40% of the fixed asset. Stock turnover with respect to cost of goods sold is 4 and debtors represent 90 days sales. Debtors are representing the 90 days sales. The company holds cash equivalent to 1.5 months cost of goods sold. Ignore taxation and assume 360 days in a year. So we have these figures as share capital, reserves and surplus, long-term loan, and these figures are given. You're required to prepare the balance sheet as on 31st March 2021 for the following format. Okay, so as on 31st March 2021, undoubtedly, share capital and reserves are already given 40 lakh and 25 lakh. Correct? Now, the net profit ratio is 8%. Now, of course, this ratio is of sales, right? So if you look at the solution, I think practical question 8 solution will be over here. See, net profit ratio is net profit ratio is given as 8%. But over here, reserves and surplus was 20 lakh and it has increased to 25 lakh. So obviously the difference over here that we see 5 lakh, that's the net profit for the year. So net profit is 5 lakh. And since the profit margin is 8%, we know net profit margin, if it's 8%, that's computed as 5 lakh divided by 8% as the sales figure. So that's 5 lakh divided by 8%, which is 62 lakh 50,000. So sales is 62 lakh 50,000. Now, since we got the 62 lakh 50,000, now we need to look at the gross profit ratio. Gross profit ratio is 20%. So if GP ratio is 20%, we know gross profit percentage, or this is as GP upon the sales, right? So similarly, cost of goods sold, we can get it as sales minus gross profit margin. So we got a sales of 62 lakh 50, 62 lakh 50 minus 20% of 62 lakh 50, that will be 50 lakh. Okay, fine. Then next thing that we have over here, the net profit ratio was given to us, gross profit ratio was given to us. So using that, we computed uh, the sales figure, the COGS figure. Then we have long-term assets being used to finance 40% of fixed assets. It means long-term loan, whatever is the amount of long-term loan, that is equal to 40% of your fixed assets. So fixed assets will be like, so 30 lakh is 40%. So 30 lakh is 40%. So what will be the 100% asset? That will be 30 lakh divided by 40%. That's 75 lakh. Then we have stock turnover with respect to cost of goods sold as 4. Stock turnover with respect to cost of goods sold as 4. We know stock turnover, it was the stock turnover ratio. The stock turnover ratio, it was COGS upon stock. COGS upon stock. So basically, we can get the stock as rearranging the terms. There will be 50 lakh upon 4, 12 lakh 50. So we had a stock of 12 lakh 50, which was being sold 4 times, and that caused the cost of goods sold to be 50 lakh. We got a stock as 12 lakh 50,000. Debtors represent 90 days sales. So debtors are representing 90 days sale. So debtors are 62 lakh 50,000. That was a full sales. So of those sales, 90 days was in debtors. So 62 lakh 50,000 into 90 by 360. That's 15 lakh 62,500. Cash equivalent, what we say over here is as a cash equivalent, and company holds a cash equivalent to 1.5 months of cost of goods sold. So 50 lakh was the cost of goods sold. Right? 50 lakh was the cost of goods sold. That's also the full year. And we hold cash equal to 1.5 months. So that's simply 1.5 by 12, 6 lakh 25,000. So we got the fixed asset figure 75 lakh. We got the debtors 15 lakh 62,500. We got the closing stock figure as 12 lakh 50,000. Cash balance is also given to us 6 lakh 25,000. Share capital 40 was given to us already. Reserves and surplus also given. Long-term loan was also given. Only the sundry debtors will be the balancing figure that we need to bring up. Okay. Sufal, sir, in the process of in the stock, in the calculation stock, we would get the average inventory. We would get the value of average inventory. Okay, so opening stock is not given. Yes, Sufal, you are right. If in the question there is no information about the opening stock, so of course, whatever is the inventory that we have, that itself would be the average as well as the closing inventory. Okay. Then what was the next question? Practical problem 2. Okay, what's there in practical problem 2? Dividend yield. Okay, let me just see. Can I take sales for calculating fixed assets? For which I think question 8 you're talking of. How can you take sales to compute fixed assets? Because there is no information for fixed assets. For sale, there is nothing ratio given. It's clearly stated as a long-term loan to be used. Long-term loan is 40% of fixed asset. That is what the question is saying. So you cannot use sales anyways. Arbitrage process. Arbitrage process will do it after the break. Debtors can also be calculated for debtors. Debtors represent 90 days sales. So it is the sales itself. Debtors, we are considering sales only, 62 lakh 50, right? For debtors, we are taking sales itself. Now, coming to the question number 2, dividend yield is not understood by someone. Okay, question 2. Capital structure of Beta Limited is as follows. Equity share capital of 8 lakh, 9% preference share capital of 3 lakh, and that totals up to 11 lakh. Additional information we have: profit after tax at 35%, 2,70,000. Depreciation is 60,000. Equity dividend paid is 20%. Market price of equity share is rupees 40. You are required to compute the following, showing the necessary workings. So first we need the dividend yield on equity share. Now dividend yield on equity shares, it is dividend per share. The formula was dividend per share upon market price per share. Formula was dividend per share upon market price per share. So what's the dividend per share? Equity dividend paid was 20%. Now, of course, that's 20% of the face value. So 20% of face value, that's like 2 rupee upon the market price of the share, which is 40. So that's 5%. Similarly, cover for preference dividend and equity dividend. Preference dividend coverage ratio was PAT upon dividend payable to preference shareholders. And equity dividend is like PAT minus preference dividend as divided by the dividend shareholders paid. Okay, and then earnings per share and price to earning are quite simple. Okay, Sapna is asking for practical question 9, debtors velocity and creditors velocity. Practical question 9. Velocity is same as turnover. Velocity is same as turnover, or I can say the debtors velocity over here, it means the debtors collection period. 3 months is the debtors collection period. And even the creditors velocity is the creditors payment period. So we know the debtors collection period is calculated as, since it is months, it is 12 upon debtors turnover. And we know it is debtors turnover means sales upon debtors. So debtors collection period is basically 12 into debtors upon, of course, the credit sales portion. Okay, and same goes with the creditors payment period as 12 into creditors upon purchases. Okay, but remember, this debtors will include your debtors as well as the bills receivable. So debtors plus bills receivable, both will be included in it. And even in creditors, you will include creditors plus bills payable. Creditors plus bills payable. Okay. Is this clear, Sapna? I hope this is fine. Debtors velocity, creditors velocity is same as the debtors turnover and the debtors collection or the creditors payment period. Is it clear? Okay, fine. Any other question that you need to look at, that we need to look at? By the way, from study material, one pertinent question which you should be looking at is the illustration number 5. Okay, because this illustration, it's actually calculates good number of ratios, and you need to be quite analytical enough to calculate these ratios and look into it. Okay. Uh, Apart from that, there are certain industry norms question also. Like for example, illustration number 6, you can see we have the balance sheet given to us and also the profitability statement, and they have certain industry norms given to us. You should be clear enough to identify, uh, whether our ratio should be higher than the industry norm or should it be lower than the industry norm. The first thing would be to calculate the ratios. Okay, calculate the ratios and then compare it with the industry norms. For example, current ratio, we have 2.67, industry norm is 2.5. So what can be your thoughts on that? What about this current ratio? What can be your thoughts? The current ratio 2.67 and 2.5, are they, what is the role of this Naga Limited as compared to industry? Is it doing good? Is it doing bad? Is it better? Of course, yes. Industry norm is 2.5, whereas Naga Limited has a current ratio of 2.67. That is better. Or I can say Naga Limited is having a better liquidity. Receivable turnover, uh, industry is 8, whereas ours it is 10. Is it good for us? Yes, industry, as compared to industry, we are doing good because in the industry, the other players are selling 8 times to their customers, whereas we are selling 10 times to our customers. So we are good in receivable turnover also. But when it comes to inventory turnover, are we good or bad as compared to the industry? As compared to the inventory industry, are we doing good in the inventory turnover? Yeah, we are, right. We are doing good. Are we? No, of course, because industry norm is 9. We are having 3.33. It means the other players, other competitors are selling 9 times of their stock. I am selling only 3.3 times. It means my stock is not moving faster as compared to the industry. The other players, other competitors are able to sell it at a faster pace, right? Similarly, total asset turnover also we are lagging behind because the industry it is 2, whereas we have 1.43. It means other competitors are generating 2 rupee sale by investing 1 rupee, whereas we are generating only 1.43 by investing 2. Net profit margins also we are lagging behind because the other competitors are having 3.5% margin. We are having only 2.1. Return on total assets, that's 7.19% as compared to 7%. Return on net worth, that's 4.81% compared to 10.5%. So the return on total asset basis, we are doing good. Whereas return on net worth, we are somewhat lagging behind. We are not generating enough profits for our equity shareholders. Total debt upon total assets is also lower. So we can find that in industry, there is a greater degree of leverage or there's a greater degree of loan fund or debt fund being utilized, whereas we are not much levered. So probably that could be the reason that we are not able to generate return on our net worth in spite of having somewhat similar or a better margin as compared to the industry. Okay, so we can say that these are the observations, and these are quite analytical observations that you need to be coming up in your exams also if such questions come up. Right, you can solve the questions of balance sheet and P&L by simple arithmetic, but then you should be able to also analyze the ratios. That's the pretty important part of this chapter. Is this fine, everyone? So let's do one thing. Let's take a break now. Okay, so that after the break we can begin with the revision of capital structure, the arbitrage, and all other things, and do some more questions also on capital structure. Okay, let's take a 10 minutes break now. So post that we can begin with our calculations or begin with the revision of the capital structure part. Take a break, guys. Back, guys, after the break. So we'll discuss the questions about capital structure and also revisit the concept of arbitrage. Modigliani Miller arbitrage was pending, so we'll discuss that also right now. Let me just share my screen with you. Yeah, that's visible. Okay, so here we have the Modigliani Miller arbitrage. Yeah, fine. Uh, so we had discussed this question of Modigliani Miller, where the arbitrage was from levered company to unlevered company. So let me just quickly revise it, and then we can think of going ahead with the other arbitrage, the secondary arbitrage. So we had this question wherein there were two companies, N Limited and M Limited. They were having the same earnings before interest and taxes. They were having an EBIT of 20,000. M Limited was a levered company which was having a debt of 1 lakh, carrying an interest rate of 7%. And N Limited was an unlevered company, whereas N had a cost of equity as 10 and this has 11.5. And we want to supposed to be knowing that how the arbitrage process will be carried out. And we said arbitrage simply means selling in one market and buying in other market in order to get profit or in order to get some sort of advantage. If that advantage exists, there will be arbitrage. People will buy in one market, sell in the other market, and ultimately, what's going to happen is after a period of time they will settle. So EBIT of 20,000. That's common for both the companies. Then we had the PAT, PBT, KE, and all those calculations we have done. Value of the firm, N Limited, which was unlevered company, it comes out to be 2 lakh, and the levered company has a value of 2,13,043. So to identify whether there is any arbitrage opportunity or not, we considered ourselves to be an investor with 10% shareholding in M Limited. Okay, so 10% shareholding in M Limited. So we were testing whether shifting our investment from M to N is going to provide any sort of additional returns. So I just calculated whether if I sell 10% stake in M Limited, the amount which I will realize, the amount which I will get in my books of account, in my bank account will be out of the total value of 1 lakh 13,000, I'll be getting a 10% of it, which was 11,304. But this value which I get from the company, it's not something which was not having, debt in it. So 11,304 was the sale proceeds. And on this, of course, there was an indirect loan. There was an indirect loan on the company, which I take it in my name, in the personal name, which is 10,000 at the rate of 7%. The total funds that we have is 11,304 plus 10,000, which is 21,304. Right. So to compensate, to match the risk profile, earlier there was an indirect loan of 1 lakh on the equity shareholder. When I am shifting my investment from M to N, I need to match the risk, because if I'm earning less by taking less risk, obviously it doesn't make any sense, because if you're earning less by taking less risk, it means you are getting an advantage. So when you're shifting from one to other, the risk should remain same. So to match the risk, we took a loan of 10,000. The total funds that we had was 21,304. We invested 21,304 in N Limited, which gave us 10.652 percentage holding. This 10.652 percentage holding in the shares of the 10.652 percentage holding in the shares, that's amount to like share in profits of N Limited is 20,000 into 10.652%, which is 2130.4. Basically, whatever is the profit that you have, 20,000, on that you are getting this share. So you have 2130.4 as the share. From that, we reduce the interest, which is 7%, 10,000 into 7%, 700. Net profit is 1430.4. So net profit that we have is 1430.4. Earlier, when we were investor in the earlier company, we were having 10% of 1300, which was 10% of 13,000, which was 1300. And of course, there's arbitrage gain. So since there's arbitrage gain, investors will move from levered entity to unlevered entity. What will happen is the value of M Limited will go down, value of N Limited will go up, and after a point of time, they will settle down at a one single price. This was a primary arbitrage we have discussed earlier. Now let's talk of a secondary arbitrage. This same question, I have done a bit of modification and I am using some different numbers to evaluate the secondary arbitrage. Now, A and B, let's say EBIT is 20,000. Interest, of course, since A is unlevered, no interest is payable. B, since it is a levered entity, interest is payable as 7,000. PAT or PBT will work out to be 20,000 and 13,000. Okay. Now, A is having a cost of equity of 10%. B is having a cost of equity of 18%. And cost of debt being the 7% itself. The value of debt is 1 lakh. Over here, value of equity will be 20,000 divided by 10%. 20,000 divided by 10%, which is 2 lakh. And that was in entirety the value of the firm. Whereas B, debt is 1 lakh. Value of equity is 13,000 divided by 18%, which is 72,222. And value of the firm is 1,72,222. Okay, now of course, which is having a greater value? It's the unlevered firm which has got a greater value. The levered firm is having a lower value of the firm. So now the investors will think of switching from company A to company B. They will think of diverting their investments from company A to company B. Okay, so let us consider as an investor 10% stake. So let's assume an investor with 10% stake in A. Okay, so an investor is having a 10% stake in A and it wants to switch to B. That is, it wants to switch from company A to company B. Now, cash received when you sell 10% stake, what will be the cash that you will receive? So out of 2 lakh, we were owning 10%. So cash that we will receive in our bank by selling our shares will be 20,000. Correct? Now, this 20,000 will be used to invest in the levered entity. Okay. Now, earlier my stake in A Limited, it was 10%, which I assume. So using the cash available, we will invest for acquiring 10% stake in equity and also 10% stake in debt. I need to match the risk also, right? Earlier in A, I was a 10% shareholder. I had 10% shareholding for the entire company. Now in B, if I just take 10% of equity, that is actually not going to serve any purpose because 10% of equity is there. You don't get an absolute right over the company assets. If you want absolute rights over the company asset, you need to be also owning the debt of the company. Suppose if I buy all the shares of a company, of any listed company, will I become the sole owner of all the assets? No, you can't. Because when the company is having loan, as an equity shareholder, you cannot exercise all your rights, right? For example, if you have got a house, that house is, let's say, worth 1 crore, but there is a loan of 80 lakh on it. Do you say that you are having full right over the house? No, you cannot. Unless and until you pay the loan, you don't have any right. So similarly, if I want to acquire, you know, rights over the company B, I need to also own not only 10% of equity, but also 10% of debt. Okay. So we say we are investing 10% of equity and we are also investing in 10% of debt. So investments that we make is basically 10% of 72,222 and 10% of 1 lakh. So investment that we make is 17,222. Sir, we had but 20,000 funds. So can I say we still have a surplus funds available as 2778. We have surplus funds of 2,778. So we received 20,000, invested 7,222 in equity, invested 10,000 in the debt. We invested 7,222 in equity and 10,000 in debt. So total investment is 17,222. And still we have surplus funds of 2,778. Quite obvious, sir, I can invest this money in risk-free assets. I can invest this 2,778 in the risk-free assets. Now, let us say what was income receivable before and after. What is the income that we receive on equity shares since we purchased some amount, some investment in equity? So earnings for equity was 13,000, right? Earnings for equity was 13,000. Since we acquired 10% stake in the equity shareholding, we will be also getting 13,000 into 10%. Even on debt, since we purchased 10% of debt, which is 10,000, on that debt, the company pays 7%. So I get 700. The total income that I have is 2,000 plus, since we had this surplus fund of 2,778, that 2,778 income on surplus will be also my additional income. Now, what was my income, sir, before switching? Before switching, what was my income, right? So my income before switching, we say it is 20,000 into 10%. Earlier, we had the income as PAT as 20,000. We held 10% over here. We had an income of 20,000 to 10%, which is 2,000. The earlier my income was 2,000. Now my income is 2,000 plus something extra income on surplus of 2,770. So can I say there is definitely a gain by investing in the other company? So investors will switch from unlevered to levered entity. And what will happen is that unlevered entity is going to have a value. Unlevered entity is going to have a value which is, the unlevered firm will have a value which is definitely more than the levered. But as the investors switch, the unlevered firm will face a reduction in value. The levered firm will face the increase in value. And overall, over a period of time, they will settle down to one equal value. Okay, so that was the secondary arbitrage. Is this clear, everyone? The secondary arbitrage? If yes, then we can go for the remaining questions that we have in the handout of capital structure. Are we clear with this? Can we go for the remaining questions in the handout? Shall we go for the next question? Yeah, guys. Praneev Vashishta, interest of 700 is not our expense. It's the income, na? Because we purchased the debentures of the company. So this 10,000 is the investment that I make. Our company will pay me interest, 700. Okay. Primary is changing investment from leverage to unlevered company. Secondary is from unlevered to leverage. Correct, Alok? Why do we need to transfer investment? Can you please repeat it? Zufa, Miss Zufa, this is a case of arbitrage that we are looking at. So I'm looking at if I shift my investment, if I transfer my investment from one company to another, am I getting some extra income? If yes, then I will go ahead with that. And that indicates that arbitrage is possible. Okay, fine. So let's go ahead with some questions now. Let's solve certain questions. Which are the questions that we did, by the way? Can you help me with the count of question? Which question have we done? We have done question number 1 is done, I suppose. Is question 1 done? Not a capital. Yeah, let's do capital structure theory problems and then we'll go back to the previous question possibly. From capital structure theory, we have done net income, net operating, that's fine. Yeah, so we have completed question 1, we have done question 2. Then I've also done question 3, right? Then question RES. Okay, so this is also done. This was basically question 7, I suppose. 7. Question 6 is still pending. 7 is done. And of course, the 10th one that we did. Correct? Let's do some more questions from this handout. Okay. So we have, let's try out this question number 12 first, guys. Let's work out with this question number 12. Yeah. But before that, yeah. The following data relates to two companies belonging to the same risk class, A Limited and B Limited. So expected net operating income. What is this expected net operating income? Undoubtedly, that is when you talk of expected net operating income, that's EBIT. We are talking of the EBIT portion. So for EBIT, we say expected net operating income is 18 lakhs. Okay, so that's 18 lakh for both. 12% debt is there in A Limited. Equity capitalization rate is 18%. What we are required to do is we are required to determine the total market value, equity capitalization rate, and weighted average cost of capital for each company, assuming no taxes as per MEM approach. So we, considering no taxes, what will be the value of the company, equity capitalization rate, weighted average cost? That's there. And then the second part is assuming a tax rate. Okay. So let's work out with the first case wherein we say there are no taxes. So case one, no taxes. So when we are saying there are no taxes involved, there are two companies which we have, A and B. The earnings before interest and tax belonging to the same risk class, obviously they would be generating EBIT of same number or same figure. We can say EBIT over here. One second. Do it over here. Question 12, A and B. We have EBIT figures for both the companies. Earnings before interest and tax is 18 lakhs. Okay. Then less interest. So of course, since A is the company which has got 54 lakh of debt, it would be paying interest on it. So the interest would be 54 lakh multiplied by 12%. Right? 54 lakh multiplied by 12%. So that will be 6 lakh 48,000. No interest in case of B. And therefore we say profit before tax was 11 lakh 52,000. And for B, it is 18 lakh. Equitization, equity capitalization rate is given to us for B as 18%, right? K, cost of equity is given to us. This is 18%. We don't have the equity capitalization rate over here. We have the cost of debt. Cost of debt as 12%. And in the other company, it is simply not applicable. Okay. So cost of debt is not applicable. Overall cost of capital, we don't know what it is. But here it is obviously going to be 18% because equity is the only capital involved in it. Now, value of the firm. We can get the value of the firm initially. What we need is value of the firm. Then we want to get the value of equity. Then we'll talk of value of debt. Value of the firm will be simply 18 lakhs divided by cost of equity being 18%. So 18 lakh divided by cost of equity being 18%, which is 1 crore, right? Then, of course, the value of equity will be same 1 crore even for B. And there's no value of debt in this case, right? We have the value of debt as 54 lakh for A Limited. And remember, we are talking of the case where there are no taxes. Now, when there are no taxes, can you tell me what will be the value of the two firms? What will be the value of the two firms? Is it going to be same or different? When we say there are no taxes in the system, what is your take on it? Are the value of the firms going to be same or different as per approach? Sir, approach without taxes is same as net operating income. There we said that the value of both the firms are going to be one and the same, and therefore we can say value of the firm will be same when no taxes are involved, right? Now, of course, value of equity is going to be a balancing figure as 46 lakh. Right? The value of the equity will be a balancing figure, 46 lakh. Now, based on this value of equity, we can actually get the cost of equity and also overall cost of capital. Now, cost of equity is, of course, PAT upon the value of equity. Now, what is the PAT or PBT? That's 11,52,000. 11,52,000 divided by 46 lakh. 11,52,000 divided by 46 lakh. 11,52,000 divided by 46 lakh. So cost of equity works out to be 25.04%. And what about the overall cost of capital? So overall cost of capital will be same EBIT upon the value of the firm. And since the value of the firm is remaining same as 18 lakh upon value of the firm was 1 crore. So that's going to be 18%. So this is a typical scenario when no taxes are involved. But we know when taxes come into picture, the system changes. There are certain changes that take place. So let us look at a scenario when we have the taxes into the system. So when we have taxes, how does the numbers fare? Let's have a look. We are talking of with taxes, what is the scenario going to be? First up, value of equity, value of debt, and the value of the firm. We can't get the value of equity for A. We already know the value of debt, by the way. Value of debt is 54 lakhs. But we don't know even what is the value of the firm, since it is with taxes. But we can get the value of the equity and the firm for B. Value of equity is going to be, of course, I'm not going to stop over here at PBT. I need to compute the profit after tax. I need to be knowing the profit after tax figure. And for that reason, we will subtract tax and get the PAT figure. Now, what's the tax rate given in the question? The tax rate is 40%. If you take 40% tax, for the first case, the tax works out to be 4,60,000. 4,60,800. So profit after tax figure will be 6,91,200. For company B, profit before tax is 18 lakh, and of course from that if we deduct the tax, that's 40%, so 7,20,000, and profit after tax will work out to be 10,80,000. Now we can get the value of equity over here simply by taking 10,80,000 divided by cost of equity being 80%. 10,80,000 divided by 80%. Divided by 0.18, 18%, that's 60 lakh is the value of equity. Value of debt is nil because there's no debt in company B. So what can we say about the value of the firm? So the value of the firm will be 60 lakh itself. What about value of firm for company A? By the way, from here till here, we know value of a levered firm will be value of unlevered plus debt into tax rate. Value of levered firm will be value of unlevered plus debt into tax rate. So value of unlevered is 60 lakh plus debt, which is 54 lakh multiplied by a tax rate of 0.4, right? So this works out to be 81 lakh 60,000. The value of the firm works out to be 81 lakh 60,000. So going backward, we can simply get this figure as a balancing one. Reverse calculation, 81 lakh 60,000 minus 54 lakh. 81 lakh 60,000 minus 54 lakh, which is 27 lakh 60,000. So we got the value of equity for company A. And now the task is quite easy to get the cost of equity. Now the cost of equity can be simply computed as whatever is your PAT, which is 6,91,200, 6,91,200 divided by 27,60,000. Divided by 27,60,000. So what's the cost of equity? 6,91,200 divided by 27,60,000, which is 25.04%. We have the cost of equity calculated. Now, overall cost of capital. I've told you the shortcut method of calculating the overall cost of capital in case of debt. I hope you remember it. So the shortcut method to calculate KO is to go for EBIT 1 minus tax rate upon the value of the firm. So EBIT is 18 lakh, 1 minus tax rate, which makes it as 18 lakh into 1 minus 0.4 divided by the value of the firm, which is 81 lakh 60,000. So the overall cost of capital should come out to be 13.24%. 13.24%, right? So that's how this clearly bifurcates the with tax and without tax scenario. Are you all getting these numbers? With tax is what is a bit challenging. Without taxes is same as net operating income, nothing great in. Are you getting these numbers? Yeah, guys. Are these numbers obtained by you? Yep. Yeah. Chalo, great. So we did question 12. Then we have this question 11. Now for question 11, I'll just show it to you how it is done. Yeah. Let's try to look at question 11. I'll just give you a gist of the solution because that's pretty easy. See, 1/3 of total market value of Sun Money Limited consists of loan stock. It consists of loan stock, which has a cost of 10%. Another company, Samsui Limited, is identical in every respect to Sun Money, except that its capital structure is all equity and its cost of equity is 16%. According to Modigliani and Miller, if we ignore the taxation and tax relief on debt capital, what will be the cost of equity of Sun Money Limited? So That's pretty simple. Now, here in this question, they have not given anything about what is the market value, what is the EBIT, no information is given. So we'll have to actually start with the assumption. And that assumption is pretty simple, that value of some money will take it as 90,000. Sir, why 90,000? Because here, you see, one third of total market value. So I needed a number which should be a multiple of 3. So I thought let's take it as 90,000 as a value. So Sangman Limited has got a value of 90,000. It's a no tax scenario. So in case of no tax scenario, we know that both the companies are going to have same value. So 90,000 is the value of the firm. Value of debt will be 30,000, which is basically one third of this. And value of equity is 60,000. Cost of debt of Sangman Limited is 10%, right? And cost of equity is nil. And then overall cost of capital is given in the question that over here, this is having a 16%. Now, Samsung also should be having the same value in the absence of any taxes. It doesn't have any debt, so overall company value will remain 90,000. Cost of equity is given as 16%. In the absence of any debt, Samsung will have same as overall cost of capital, and this will flow over here as 16% itself. And we don't know what's the cost of equity. That's pretty simple to solve because KO is equal to this overall cost of capital or weighted average cost of capital. We know this formula. Overall cost of capital for this Sangmadi Limited is 16. So one third of 10%, which is debt, plus two third of cost of equity. You can just solve this and get this KE as 19%. So I just want you guys to solve this equation and see whether you are getting the KE as 19%. Just check, guys. Quickly solve it within 2 minutes. Solve this equation and see if you're getting 19% as the answer. Go ahead, guys. Try to solve it. The only trick lies in solving the equation. Apart from that, the question is very simple. Try to solve this question and get the value of KE. Get the value of KE, guys. You getting it? Yes. Getting 19%. Okay. Great. That's 19% for you. That's pretty simple. Done with question 11. We're already done with question number 10. Now, look at this. Question number 9. Question number 9. Alpha Limited and Beta Limited are identical except for capital structures. Both these companies are identical except for capital structure. Alpha Limited has 50% debt, 50% equity, whereas Beta Limited has 20% debt and 80% equity. So capital structure is different for both of them. All percentages are in market value terms. The borrowing rate for both companies is 8% in no tax world. And capital markets are assumed to be perfect. So first thing they say, if you own 2% of the shares of Alpha Limited, what is your return if the company has a net operating income of 3,60,000 and overall capitalization rate is 18%? What's the implied required rate of return on equity? Beta has the same net operating income as Alpha. What is the implied required equity return of Beta? And why does it differ from that of Alpha? Okay, so let's try to solve this question number 9. So we have got two companies, Alpha and Beta, with different debt equity ratio. Okay. Now, over here, they have different capital structure, and they're saying no tax world, perfect capital markets, right? These were the assumptions of all our capital structure theories, by the way. So now over here, we have Alpha and Beta. The debt equity ratio, which they have specified, the debt equity ratio for Alpha is 50-50. And for Beta, it is 20-80. Borrowing rate, we can say cost of debt, that is same for both the firms. That is same for both the firms. Now, if you're saying borrowing rate is same for both the firms, and we have to take an assumption, we are going to assume, are we going to take it as a net operating income approach or net income approach? We are going to assume the NOI approach. NOI approach is assumed over here, because otherwise you cannot go ahead with the calculation. Because if your cost of debt is 8%, but whereas overall cost of capital, it says that overall capitalization is 18%. Okay, so for Alpha it is 18%, and it has the same operating income as Alpha. So we have not been given any sort of information as to what will be the resultant impact on Beta's overall cost of capital. No information is given about that, and we cannot take any other thing. So it's better on a safe side to assume net operating income, because the question is silent. We'll always go for the assumption which makes it simple, right? So we say that it's a net operating income, and due to that, the question has given the overall cost of capital, KO. KO is 18% for Alpha, and that's going to be same even for Beta, because we are assuming net operating income. Now, both the companies have got the same EBIT level also. So earnings before interest and tax, we find that for Alpha, it is 3,60,000, and that's remaining same even for Beta. So even for Beta, it's 3,60,000. Value of the firm is going to be EBIT upon KO, right? EBIT upon KO, which is 3,60,000 divided by 18%. That works out to be 20 lakhs. And that's going to be the same even for Beta Limited. And value of equity, Alpha will have to say, and also with regards to value of debt also, since the debt equity ratio is given as 50-50, so we'll say value of equity is 10 lakh, and even the value of debt is 10 lakh because of that 50-50 ratio. And with regards to Beta, the ratio is 20:80. So 80% it is equity, which means 16 lakh is going to be the equity, whereas debt is going to be 4 lakh, which is just the 20% figure. Okay, so now let's talk of the PAT and PBT things also. Since we have the EBIT figure available, from that we are going to reduce the interest. We get profit before tax, and since it's a no tax scenario, there's just quite easy enough. So EBIT is 3,60,000 for both the firms. Interest that we pay is 8% of 10 lakh. 8% of 10 lakh. which is 80,000. Profit before tax is 2 lakh 80,000. Then EBIT, since it is 3 lakh 60,000, interest is going to be 8% of 4 lakh. 8% of 4 lakh, that's just 32,000. And we get a profit before tax. Profit before tax as 3 lakh 60,000 minus 32,000, which is 3 lakh 28,000. Cost of equity is, it is PAT upon value of equity, which is 2 lakh 80,000 divided by equity of 10 lakh. Then 3 lakh 28,000 over here divided by 10 lakh, which is 20.5%. That's your cost of equity, 20.5%. Now the question says, if you are owning 2%, if you're owning 2% of the shares of Alpha Limited, what is your return if the company has a net operating income of 3 lakh 60? Okay, so if you own 2% of the company, if you're owning just 2% of the company, what is your earnings going to be? So if you own 2% of Alpha, right? 2% of Alpha. So what is your investment, by the way? Sir, investment that you have in Alpha is 10 lakh multiplied by 2%. 10 lakh multiplied by 2%, which is 20,000. And what is the share in PAT? So PAT is anyways 2 lakh 80,000 into 2%, which is 5,600. The return that we get is 5,600 on an investment of 20,000. That is 28%, which is, same as the cost of equity. Same as the cost of equity. Yeah. We have assumed the net operating income over here. If you assume it, other way around, you take an assumption of other way around, then of course the different answer is going to be there. So let us say, I'll just tell you one thing. Yeah. So what about beta? Beta, can I say you will get the same 20.5% in case of beta also, right? Beta, you will get this in the similar lines. Beta K of beta is 32.8. Oh, sorry, this is the mistake. It's not divided by 10 lakh. It is divided by 16 lakh. Correct. Okay. Then we're done with this question. Question number 9. Then again, 8th question is on the similar lines. We look at question 8. That's on the similar lines which we had seen earlier. So I'll just run you through the solution for this. Stopco Limited and all equity finance companies considering a repurchase 200 lakhs of equity to replace it with 15% debentures of the same amount. So basically, company is considering buyback of equity by issuing debentures. Current market value of the company is 1140 lakhs and its cost of capital stands as 20%. Its earnings before interest and taxes are expected to remain constant in future. Its entire earnings are distributed as dividend. Applicable tax rate is 30%, and you are required to calculate the impact on the following on account of change in the capital structure as per Modigliani and Miller hypothesis. So, as per Modigliani and Miller hypothesis, we are supposed to be calculating the market value of company, its cost of capital, and its cost of equity. Okay, so let me just run you through the solution for the same. Question number 8. I'll be uploading these solutions, by the way, after today's class. Or let me just do one thing. I'll solve it for you. Question 8. Yeah, question 8. So Stopco Limited and all equity finance company is considering repurchase of 200 lakhs. So let's first talk of the two scenarios. One is the unlevered scenario, and which is the original case. And second is the levered scenario, which is the new case. We have the value of equity, value of debt, value of the entire firm, cost of equity, cost of debt. And of course, we prepare the income statement also for all our calculations, which is EBIT less any interest that we pay. Then we have profit before tax. Then we have the taxes. And finally, the profit after tax. So EBIT, is it given to us? Any form of information EBIT? No, sir. Whatever we have is the current market value and all such things. So okay, let's write down the current market value of the company. Current market value of the company, which is a fully equity company, that's 1140. And in the current scenario, we don't have any debt, so our value of the firm is 1140 itself. Cost of equity, current cost of capital was 20%. Cost of debt was not applicable. We can do the calculation as cost of equity, since it is 20% and value is 1140. We can get the PAT figure. So the PAT figure over here is going to be 1140 into 20%. So 1140 multiplied by 20%, that comes out to be 228. This is a profit after tax figure. This is a profit after tax figure. We can get the tax and the PBT accordingly by doing a simple reverse calculation. Okay, so we can simply take that as like PBT being 100, interest being 30, PAT should be 70. So by the cross multiplication, you will get a PBT as 325.7. Since no interest is paid, this 325.7 is itself the EBIT. And when you're going for changing your capital structure, when you're going to change the capital structure, EBIT is not going to change. EBIT, your operating income, is going to remain same as 325.7. So that's 325.7 remaining same. But here we are going to pay interest. So in the levered scenario, we are going to have the value of debt to be 200, right? And on this debt, we are actually going to pay 15% is the before tax cost of debt. So interest, we're going to have the interest amount in case of the levered scenario as 200 multiplied by 15%. 200 multiplied by 15%, which is 30. And your PBT is 295.7. Taxation, subtracting 30%, that should make it as 207. Now, any idea, guys, how can I get any idea as to how can I get the value of the firm over here and value of equity over here? Any idea what can we do about the value of the firm and value of equity? Yeah. How can we get the value of the firm and the value of equity? We can simply get the value of the firm by using a pretty simple formula, right? And that's going to be value of levered firm is equal to value of unlevered plus debt into tax rate. So that's like 1140 plus the debt amount is 1140 plus the debt amount was 200 multiplied by the tax rate, which was 30%. So 1140 plus 200 into 30%, they'll make it as 1200. And since the value of the firm is 1200, by doing a reverse calculation, we can get the balancing figure as value of equity, which is 1000. Right? So here we have filled up everything. Now we are left with just one figure. And that is cost of equity. So cost of equity is PAT divided by this thing. So that's 207 divided by 1000. 207 divided by 1000, which is 20.7%. Right? That's 20.7% as the cost of equity. And what about the overall cost of capital? Overall cost of capital, we know it is going to be, of course, for the levered entity we are talking of, that's shortcut method, EBIT 1 minus T upon value of the firm. Right? So EBIT was 325.7, 1 minus 0.3 divided by value of the firm is 1200. Right? So overall cost of capital, you'll find it works out to be 19%. Okay, so that brings this question 8 to an end. Are we good with this? Value of the firm. Alok, value of the firm will not be same because it's a scenario of taxation. Tax rate is applicable, right? So it cannot be the case that they are same. They are same only if there is no tax available. I mean, there is no tax applicable. When there is taxation, then you have to look at this formula. Value of levered being equal to unlevered plus debt into equity. Okay, that's our question number 8. Now, question 6 is what we have done. That was actually 7. Let's consider this question number 5 as the last question for the day. And let's get it done from here. Yeah. Question number 5. Or maybe for that case. Zenith Limited is presently financed entirely. Prachi, how EBIT is same? EBIT is obviously going to be same, Prachi, because it's the same company, right? So Zenith is, let's quickly solve this question 5. Zenith is presently financed entirely by equity shares. The current market value is 6 lakh. Dividend of 1,20,000 has just been paid. The level of dividend is expected to be paid indefinitely. Company is thinking of investing in a new project involving an outlay of 5 lakh now, and it is expected to generate a net cash receipts of 1,05,000 per annum. The project would be financed by issuing 5 lakh debentures at a market interest rate of 18%. Ignoring tax consideration, calculate the value of equity shares and the gain made by shareholders if the cost of equity rises to 21.6%. Prove that the weighted average cost of capital has not been affected by gearing. Okay. Now, we can say that this question is simple, pretty simple. Now, of course, whatever is our earn, we are going to say that it is 100% dividend payout. Current scenario is fully equity, and currently it is valued at 6 lakh. Dividend 1,20,000 is being paid. So basically, whatever is your EBIT, no interest is being paid out of it. So entire EBIT is your PBT or PAT, right? So now it says it is investing in a new project initial involving an outlay of 5 lakh now, and is expected to generate a cash receipts of 1,05,000. So when you're going for new debt, obviously EBIT is not going to remain same. It is going to increase by 1,05,000. So there's an increase of 1,05,000 in EBIT, but we are going to fund this project by way of debt. So debt of 5 lakh. On 5 lakh, you're supposed to be paying interest of 18%. So that's 1,35,000. Then we have to calculate the value of equity shares and gain made by the shareholders if the cost of equity rises to 21.6. So as of now, what's the cost of equity? Sir, 1,20,000 on 6 lakh, which is 20%. Overall value of the firm today it is 6 lakh. Now the question says that K is rising to 21.6%. So value of equity or value of shareholders is going to be PAT upon K, which is 1,35,000 divided by 21.6. Okay. So that's 6,25,000. Value of the firm is a sum of this plus 5 lakh debt. So 11,25,000. Gain to equity shareholders after investment is like equity shares were having a value of 6 lakh. Now it has become 6,25,000. So there's a gain of 25,000. Before investment, KO was 20%, and after investment, KO is also remaining 20% because that's 2,25,000 on an overall investment of 11,25,000. So that's a pretty simple question. I'll be uploading this solutions on the portal for your reference. And with that, we are through with the revision portion of the capital structure also. So we're done with the PNL, not PNL, but the ratio analysis and also the capital structure portion. So we'll stop here for the day. For the time being, we have one more session left on Saturday in which we'll be discussing the topic of leverage. We'll be learning the topic of leverage in the next class. Till that time, take care and bye bye. Good night, everyone.